Hey guys, today we're going to be talking about Micron stock and their company. And you can see from this trading view chart that they were trading at $470, that's their all-time high, per share in March. And now they've dropped over 34% at the lows and then came back up a little bit to now trade around $380 per share, roughly. So in this video, we're going to go through Micron's business, their moat, headwinds, tailwinds, things like that. Looking at their financials, they recently reported in March to see what their financials look like, what their numbers and top line, bottom line, all those numbers look like. And finally, we'll wrap it up with a valuation on Simply Wall Street and also maybe some custom valuation metrics from my own research to see where the fair value of this company really lies and whether they can protect their moat, their business into the future from competitors and from the industry dynamics itself. So if you like this content, please like and subscribe, and let's get straight into it. Now, Micron designs, manufactures, and sells memory and storage products worldwide. So you can see how important memory is in this AI age and revolution. Data centers require memory. All the chip manufacturers require memory. It's a very important piece of AI right now. So you can see where their revenues have been trending, and it's going up because of all this AI demand. The company operates through four major segments: compute and networking business unit, mobile business unit, storage business unit, and embedded business unit. The company offers memory products for the cloud server, enterprise, client, graphics, and networking markets, as well as for smartphone and through other mobile device markets. And then solid state devices and component level solutions for the enterprise and cloud, client, and consumer storage markets, other discrete storage products in component and wafers, and memory and storage products for the automotive, industrial, and consumer markets. So now some of the overall stats for the company: they have a market cap of about $425.48 billion right now. Their enterprise value is of $421.69 billion. That means that difference is essentially their net debt, and that stands at negative $3.79 billion, which is really good because if their enterprise value was higher than their market cap, that would mean they would have positive net debt, which is not great. They have 1.1 billion shares outstanding. They have revenues, trailing 12-month revenues of $58.12 billion. They have 53,000 employees. Gross margins for the trailing 12-month are sitting around 58.4%. EBITDA margins, 63.4%. Operating margins, 48.3%. Their pre-tax is 48.1%. Net income margin is 41.5%. And free cash flow margin is 17.7%. So these are really good numbers. High gross margins, high EBITDA margins, high operating margins, and they have cash balance on the balance sheet. You would expect a higher PE multiple being given to them just because of how integral they are to the AI narrative, which usually is part of the high growth narrative. But they have a 17.3 PE, trailing 12-month. Price to book is 5.9. EV to sales is 7.3. EV to EBITDA is 11.4. Price to free cash flow is 41.4. So analyst price targets is $527.6 per share. Next 12-month PE is 9.8. So they're anticipating either a decrease in the price or an increase in the earnings per share. Their PEG is at 0. EV to sales is 5.1. And the cash on the balance sheet is $14,590,000,000. Now, if we go to what bulls and bears are saying here on Fiscal AI, the bulls' thesis is that when memory markets are in an upswing and demand is strong, Micron sales growth and profitability can be impressive. Micron is benefiting from immense growth in HBM revenue due to high investments in AI infrastructure, boost the firm's growth and margin profiles. We like Micron's shareholder returns and view its balance sheet as strong for the cyclical firm. Semiconductors is usually a cyclical business. When the market troughs, cyclical businesses, if you have a strong balance sheet, you can weather that storm and your share price doesn't get hit too hard. So that's what bulls like about Micron right now. The bears are saying that Micron has high fixed cost base that leaves it vulnerable to underutilization charges and major profit compression when memory enters a downturn. We see DRAM, or dynamic random access memory, and NAND as commodity-like products, and we foresee little ability for Micron to build durable differentiation against its competitors. So that's the definition of commoditization. And commodities, they are the same across the board. No matter what competitor you use, no matter what company you use, you'll get the same product. That's a commodity. You can get oil from any one of many oil companies, but they'll all be the same oil. So that's a commodity. So things are like gold, oil, wheat, or anything like soybeans. Those are commodities because the product is the same at the end of the day. And the company that produces it and delivers it to the market is not really differentiating the soybeans or the gold or the oil. If memory is a commodity, then Micron is just one of many competitors in the space that could provide the same thing. That's what bears are saying. Micron is extremely sensitive to memory pricing, and weaker pricing growth in an upcycle or more volatile down cycle in the future can greatly depress its results and valuation. I mean, this is all true. If the market does go down and the prices go down, they don't have much they can do to, offset that type of downturn in prices. Top line and their bottom line are going to get hit. Even if they're selling more at a weaker price, it's not going to produce the same revenues and bottom line as it would in a high upcycle with high prices. And I would even add that another bear argument is that its revenues are increasing massively only because of AI. So it's become so dependent, like a lot of companies, so dependent on AI narrative that any downturn there or any lack of demand will cause their revenues to fall immensely. And it's pretty sensitive to that. So I think that's what bears are saying here. And you kind of saw that in the last month. There was a news piece that Google figured out a way to reduce memory costs in AI chips. And at the announcement of that news, Micron fell. It fell a lot because if you don't need as much memory, if Micron can't sell as much memory to their customers because they're not needed, then their revenue is going to fall. The demand has lessened because efficiency in tech has increased. That's a classic tale of efficiency increases leading to certain industries being downgraded or used less, needed less. So that's another reason that Micron can be hypersensitive to these type of things. Now, one of the cool things about Micron, it's not fabless. So it maintains the vertical structure, integration structure of its business. It produces and manufactures the chips themselves and markets them and sells them. So it's not like a NVIDIA or AMD type of company where it's fabless, fabrication less, where they outsource their chips to build a custom solution in their factories and business. It's more integrated, vertically integrated. Now, here is the article that I was mentioning about Google AI breakthrough leading to reduced need for memory. And this is pressuring memory chip stocks from Samsung to Micron. So Micron is directly affected by this. Google said this week that its research on a new compression method can reduce the amount of memory required to run large language models by 6 times. So what does that potentially mean? That means you might need potentially 6 times less memory to achieve the same output for your AI models, for your AI integration, for your AI data centers, whatever it is. You might need many times less memory than you actually did before. And that leads to a reduction in the amount that needs to be bought from Micron, Samsung, SK, Hynix, all these companies. So they all fell, obviously, when investors feared that they needed fewer memory chips to be required in the future. However, analysts said the sell-off was likely profit-taking and Google's research could lead to more advanced AI, which will eventually need more memory chips. It's kind of like a double-edged sword where they are getting more efficient, but also due to that efficiency, they're going to be using them more to make more advanced AI. So it's really a balance of efficiency and increasing the product to a point where that is also more advanced. So we don't know where it's going to shake out, but the initial impact was a downturn in all those memory stocks, and now they're coming back up. Okay, so now let's move on to their financial results from Q2 of 2026, and also their press release surrounding that announcement. So here we have the chairman and CEO is Sanjay Mehrotra, and the overview is Micron delivered an exceptional fiscal Q2 with stellar records in revenue, gross margins, EPS, and free cash flow. Quarterly revenue nearly tripled versus 1 year ago, and revenue for DRAM, NAND, and HBM, which is high bandwidth memory, and each business unit reached new highs. Our fiscal Q3 single quarter revenue guidance exceeds the full year revenue for every year in our company's history through fiscal 2024. So you can see how big this AI narrative has changed their financials. Their revenue has gone through the roof and exceeds the full year revenue for every year prior to that. For fiscal Q3, we anticipate exceptional records across revenue, gross margin, EPS, and free cash flow. Reflecting confidence in the sustained strength of our business, I am pleased to announce that our board has approved a 30% increase in our quarterly dividend. But we don't see any mention of buybacks. So really quick, let me just check that out. And here on Fiscal AI, you can see that their shares outstanding have not gone down. Let's continue with this. The step up in our results and outlook are the outcome of an increase in memory demand driven by AI, structural supply constraints, and Micron's strong execution across the board. Our memory and storage solutions are at the heart of this AI revolution. Memory makes AI smarter and more capable, longer context windows, deeper reasoning chains, and multi-agent orchestration. As AI evolves, we expect compute architectures to become more memory intensive. That's why we strongly believe that Micron is one of the biggest beneficiaries and enablers of AI. AI hasn't just increased memory demand for memory, it has fundamentally recast memory as a defining strategic asset in the AI era. So they go into technology, the technology updates. They're making excellent progress ramping up our industry DRAM and G9 NAND technology nodes. They expect that to be the highest volume node in Micron's history. They plan on increasing their EUV, extreme ultraviolet adoption at the 1 Delta DRAM node utilizing the latest generation EUV tools. ASML holds the top position here because they're manufacturing the machines, the EUV machines that they sell to Samsung, to Micron, to SK Hynix, and companies like that, which use them to create these chips for their own purposes, for memory, for other things. So these more advanced EUV tools will help us optimize both clean room space efficiency and patterning when scaling to 1 Delta and beyond. In NAND, and that's basically a technology, NAND is a technology where you can store data without using power. Our G9 node also remains on track to constitute a majority of bits by mid-calendar 2026, and they just go through a lot of other, technological updates here. Data center server demand. AI demand is driving DRAM and NAND data center bit TAM, total addressable market, to exceed 50% of the industry TAM for the first time in calendar 2026. Traditional server demand is robust, driven by a combination of demand from workloads initiated by agentic AI, as well as broad-based server refresh. AI server demand continues to be strong, and we can see that in the revenues that they are generating. We expect server units to grow in the low teens percentage range in calendar 2026, driven by AI and traditional servers, and we expect that to continue to grow. And then they talk about high bandwidth memory and more stuff about DRAM and NAND. But let's go to market outlook. We expect both of these to be constrained by supply in 2026. We continue to expect supply-demand conditions for both DRAM and NAND to remain tight beyond calendar 2026, which is good for Micron. We expect industry DRAM bit shipments to grow in the low 20s percentage range, slightly above our prior outlook. So all in all, pretty good, and a good guidance going forward that I can see. So here's the numbers. Fiscal quarter 2, 2026 revenue was $23.9 billion. Revenue is up 75% quarter over quarter and up 196% year over year. I mean, that's an amazing number, and it's all due to AI. So that's very impressive AI performance. DRAM, $18.8 billion, representing of that, which is 79% of the total revenue. $5 billion from NAND, which is 21%, the remaining amount. Revenue increased 207% for DRAM year over year, 74% quarter over quarter. Bit shipments, mid-single digits quarter over quarter. And for NAND, it was 169% year over year, 82% quarter over quarter for NAND. So here they broke it down by business unit. The cloud memory came in with a revenue of $7.749 billion, gross margins of 74%, operating margins of 66%. Core data center, $5.687 billion, 74% gross margin, 67% operating margin. Mobile and client, this is where you have your phones and stuff like that, chips for phones and things like that. $7.711 billion, 79% gross margin, operating margin of 76%. You're noticing that the gross margin and operating margins are really, really high. And that's really important for the numbers and financials of Micron. Automotive and embedded, cars, things like that. Revenue of $2.708 billion, gross margins of 68% and operating margins of 62%. So all in all, huge increases in between quarter over quarter and year over year, as you saw in the numbers. So non-GAAP operating results, you saw the revenue, $23.86 billion, gross margins of 74.9%, operating expenses of $1.42 billion, operating income of $16.46 billion, net income of $14.02 billion, diluted earnings per share is $12.2 per share, and cash from operations, $11.9 billion. Cash flow and capital allocation, this is the slide that investors need to look at, long-term investors especially. Okay, so they do have some money going towards repurchasing shares. They spent $1.4 billion towards repurchasing 14 million shares from fiscal year 23 to fiscal quarter 2 of 2026. $1.8 billion towards dividends paid, so they kind of do buybacks and share dividends. They're also diluting the share count, so this is probably just to keep the status quo in the shares outstanding. $3.2 billion returned to shareholders from share repurchases and dividends. Cash flow from operations, $11.9 billion, which is 50% of revenue. Net capex, $5 billion. So they're spending $5 billion this quarter in capex. And that seems reasonable right now if they're not dipping into their, cash on the balance sheet. That seems very affordable for how much cash they're producing from operations. But we do have to make sure that that number doesn't explode higher like some of these other, hyperscaler names. Adjusted free cash flow, $6.9 billion. Buybacks, $350 million for last quarter. Dividends of 15 cents per share will be paid on April 15th. Liquidity, $20.2 billion in liquidity at the end of fiscal quarter 2, 2026. So non-GAAP guidance for fiscal quarter 3, 2026. $33.5 billion plus or minus $750 million. Gross margin approximately 81%. Operating expenses approximately $1.4 billion. Diluted earnings per share $19.15 plus or minus 40 cents. So this is about $10 billion higher than what they produced in fiscal quarter 2, 2026, which is an insane amount of increase in revenue. But their gross margins are also very high at 81%. So we're going to see some big moves in the stock and the stock price and in their numbers going from this quarter to next quarter. So their full outlook, we expect higher price, lower cost, and favorable mix to all contribute to a gross margin expansion in Q3. That's great to see for investors. As mentioned in last quarter, Micron's fiscal Q4 2026 OPEX will also reflect the effect of an additional work week in this 53-week fiscal year. We expect an increase in our fiscal 2027 OPEX as we ramp R&D investments in support of an unprecedented set of long-term opportunities in memory storage. They're telling us right now that they're going to increase R&D investments, so their OPEX, operating expenses, will be higher even in fiscal 2027. And we expect fiscal Q3 and fiscal year 2026 tax rate of around 15.1%. So that's great because the corporate tax rate usually is around 21%. So they're still getting a discount there on their taxes. Micron continues to invest in a disciplined manner across our global footprint to address customer demand. As mentioned earlier, we now project our capital spending in fiscal 2026 to be above $25 billion. So there's the capex for full year fiscal 2026. In fiscal Q3, we expect capex of approximately $7 billion, and they only spent $5 billion this quarter, so they're significantly ramping that up, while delivering significantly higher free cash flow on stronger operating cash flows. They definitely did. Due to the need for clean room capacity, we expect our construction spend growth rate to outpace equipment spend growth in both fiscal 2026 and fiscal 2027. So clean rooms are basically how the fabrication rooms, and they need to keep them exceptionally clean so that no dirt or debris, dust, anything like that gets on the chips when they start manufacturing. You kind of seen these, you may have seen these. All the workers in them are dressed in like white scrubs and full body coverings, where they create the actual chips using the EUV machines and things like that. So let's move on to the press release here. And a lot of these numbers we've already gone through. The revenue, 23.86 billion versus 13.64 billion prior quarter. And the next quarter, they're anticipating 33 billion. So it's going by leaps and bounds here. GAAP net income of 13.79 billion or $12.07 per diluted share. Non-GAAP of 14.02 billion or $12.2 per diluted share. Operating cash flow of 11.9 billion versus 8.41 billion for the prior quarter and 3.94 billion for the same period last year. So new records across revenue, gross margins, EPS, free cash flow in fiscal Q2. And here they have the same breakdowns of the quarterly fiscal results and the business unit results and the outlook, the guidance for full year and FQ3 2026. Okay, so let's go to the valuation. Here on Simply Wall Street, they have a 34.2% overvalued indication on here, and the cash flow value is actually $272.81 per share. And the reason they are getting this, let's go to the data and how they're backing that number up. They have 7 analyst estimates on average from S&P Global, giving the levered free cash flow estimates for a certain number of years, usually 5 years. They're using a 2-stage free cash flow to equity model. Their discount rate that they calculated is 10.6%. Perpetual growth rate is a 5-year average of the US long-term government bond rate at 3.4%. So going into the actual calculation, here's the actual calculations for the discount rate. They used a beta of 1.89 that they got from S&P Global and relevered that to 1.62. Now looking at the chart for the 10-year stage 1 projections, 2026 they have a levered free cash flow of $37.728 billion from 12 analysts. The present value discounted is $34 billion. And so they just do this for every year. And you can see that they have huge growth from 2026 to 2027, but then it starts declining after 2027. So these analysts are anticipating a peak in 2027 in the levered free cash flow of the company. Either they are ramping up CapEx so much that it is cutting into their free cash flow, or this is just demand has peaked and it's waning after that because maybe efficiency upgrades in technology have rendered using so much memory and so much memory chips obsolete, or just, they don't need as much, as you saw with the Google news. Then it drops slowly, and then it starts accelerating after that. So from 2028 to 2029, they anticipated like a $17 billion drop. And then 2029 to 2030, they're anticipating about a 50% drop. I'm not sure what's going on there, but we'll have to do the research on that. 2030 to 2031 drops a little bit more, and then it just keeps going down from there. 2035, they're anticipating only a levered free cash flow of $15.156 billion. And that's how they sum the present values of all of these levered free cash flows here to $228.737 billion. Then the second stage of a 2-stage equity cash flow analysis is to find the terminal value, which takes the last year's, the 2035 free cash flow, and put it into this equation here with the discount rate and the terminal rate for the Gordon growth method. And that will give you the terminal value in perpetuity. So 10 years, and then you get a terminal value that describes or explains the cash flow value for the entire rest of the existence of the business. And so they get the present value of that terminal value and then add these together. They add those together to get 307.660 billion. And then they divide by shares outstanding, which is 1.128 billion. And that gives them a $272.81 equity value. So that's one cash flow analysis. But I also am excited to introduce to my Patreon members a cash flow sheet that I am building. And it's not done yet, and it's not live yet, but once it is, I will definitely post it on my socials, and to my Patreon members, my paying Patreon members will get access to this. So I've been playing around with this, and basically you can put in any stock ticker. I put in MU here, and it will populate what you need for, you know, current price, discount rate, and shares outstanding. You can change a lot of things here because every company is unique and individual. It requires a certain finesse in how you treat it, and they all have different circumstances. Some are REITs that you can't do with a two-stage equity cash flow projection. Some are banks that don't really work here, and some just are dividend payers. They produce a lot of dividends, and you can't really analyze their cash flow like a traditional company. So I'm building this for mainly growth companies and companies that are mature, are profitable. You have to have a profitable company to be able to analyze their discounted cash flow, and are producing pretty steady cash flows that you can analyze through here. That's kind of what this is made for. And so I've been building it. When you put this ticker in, you'll get, you know, several pulled in data already, so you don't have to find them. But there are certain things that you have to pull in, like net debt. You have to pull in terminal growth, which would be the 5-year average rate. The shares outstanding sometimes is different than what the ticker says. For example, Google has 2 different class of shares. So one is Google and one is Goog, and they have different class shares outstanding. So you have to combine them to get the actual DCF valuation. And so risk-free rate, you know, beta, you have to re-lever that beta, things like that. And the base year drivers are derived from the trailing 12-month data. So those also have to be tweaked and adjusted year to year, just like those analysts were adjusting those different years on Simply Wall Street. So I'm working through this. I'm just showing you this right now just so you know what's coming. But once I get this into a finalized or close to finalized state, it'll be rolling out for my Patreon members. This is another stock that I'm going to put into my, you know, template that I have here. I also have a list of companies that I'm going to be adding here, and actually I can show you guys that. In the overall section here, we have all the companies that I've analyzed so far and their valuations through Simply Wall Street. And also, once I do the analysis through my finalized model, DCF model, I'm going to put my own research valuation here. And I will be updating those. New earnings come out, 10Ks, 10Qs, things like that. I will be updating these valuations and doing like in-depth research into each of these companies and their company circumstances, news for my own fair value. And I will post this here, and these will be available to all my Patreon members. That's it, guys. I hope you like this content. Please like and subscribe if you haven't already. There is still one more discounted spot for my $2 a month Patreon. So if you want to hit that up, you'll get access to what I just showed you, plus a lot more, my Discord, Substack articles about the market and commodities and stocks that I analyze. You get my buys and sells on Patreon. That is, do buys and sells almost every week, every other week. So that's really useful if you want to look at what I'm doing and how I'm building the public account. And you get to chat in my Substack AMA. So you can ask me anything in that AMA, and I will try to respond to the best of my ability. So that, guys, I'll see you guys in the next one.